SOFI Technologies, ticker symbol SOFI, dropped some 13% after earnings. How bad were the earnings to cause such a ridiculous drop, such a violent move down? This is especially bad. After year to date, it's dropped around 50% from its highs of around $32 to now $15.50. So what caused this drop? How bad were the earnings? That's going to be the subject of this video. This video is going to be my take on the SOFI earnings. Here's the transcript, and then here are all my notes that I took. It's been some 2 weeks since the earnings, and honestly, I've filmed this now 3 times. There's just been too much news that's been coming out, and I'm just going to put this all in one video so I don't have to make another video on this. So let's go over the key takeaways. So starting off, just a summary of SOFI's earnings. They were actually really good. It just shows you that the business is growing, that it's really just not stopping, right? They're firing on almost every cylinder. We'll talk about the tech platform later, but let's just get into it. The one thing that I talked about in my SOFI earnings prediction and kind of things I'm looking for in the SOFI earnings was this acceleration of products versus members. Because when you see products growing faster than members, it shows you that SOFI's flywheel, which is basically their main claim to fame, is working, right? It shows you that the customer that SOFI has is very sticky and not willing to leave the ecosystem. And you have that. Members growing 35% year over year. We also added products growing 39% year over year, right? So products growing faster than members is really good. And members in itself is already at 14.7 million, 35% year over year. That's a big number. Going on, we have 18th consecutive quarter of following the rule of 40 with a score of 72, reflecting a 41% revenue growth and 31% EBITDA margins. And second consecutive quarter, generating more than $1 billion in cash revenue. These numbers are not something to scoff at. These are really good numbers for just a bank. You don't see any regular bank just growing 40% year over year. Continuing, you see total deposits by members growing $2.7 billion to $40.2 billion, mainly by member deposit. So that tells you that the customer isn't just using SOFI for a specific product or 1 or 2 products, or using it as a secondary or tertiary bank. A lot of members are putting their money, their paychecks in SOFI, right? They're doing direct deposits into SOFI Bank. So a lot of members are starting to use SOFI as their primary bank, not just some tertiary bank that you use for a credit card. Another thing to note is that they expect their financial service revenue to grow at least 40%. So that shows you that their growth isn't just past performance. It isn't just a one-time thing, but management expects to see continued growth of at least 40%. They don't expect a tapering off or a leveling off of their growth, of their revenue. They expect continued growth of at least 40%. Another thing to note is that their tangible book value is now $9.2 billion at $7.21 a share. At its current price, that means that SOFI is approximately trading a little bit more than 2 times tangible book value. So I want you to just think about that. SOFI Bank and everything that SOFI has in it is growing at just 2 times tangible book value. Is that expensive for technically a bank stock? Maybe, but imagine if SOFI were to just split into 2 companies. SOFI said tomorrow, they said, okay, well, we decided that we would split SOFI Bank with SOFI Technologies. It's the fact that the only excuse that people have for valuing SOFI so low is that it's just a bank. Because when you value a company, it isn't just, you don't just base it off of what sector or what business they're doing. Because it doesn't matter what business you're doing, as long as you show good growth, there should be a value on that growth. Think about companies like Caterpillar or any AI infrastructure play. Those oftentimes they usually don't get that high of a PE ratio. They don't demand that high of a PE ratio because you don't expect that company to grow that much. But with the AI buildup that's been happening recently, then people are starting to price in that growth. And then they're giving those stocks a higher multiple. That's how you're supposed to value things, by their growth and by their potential. In the same vein, just because SOFI is a bank doesn't mean you should value it as a bank because it's growing 40%. And then there's this final point, which every bear harps on, which is earnings per share was 12 cents. And everyone is talking about how, oh, SOFI didn't beat expectations, they only met expectations. And I think that's just... So just a note on this, the way Anthony Noto sets his expectations, Anthony Noto isn't purposely trying to sandbag. He has a range of what he expects their company to do, and then he always guides on the lower side of the range. because he knows he can make this lower side of the range. And he doesn't want to ever miss expectations or misguide, because in missing guide, you're eroding your trust that your shareholders have. And I have this clip of Anthony Noto in this interview that he had with Tanner and Tevis.
These intangible things all have to triangulate back to trust. And if people don't trust us, they're not going to give us their money. And so when we're given guidance, it's not just about what can we deliver to the financial community and to our shareholders, but it's also considering reputational risk and brand. And are we building a brand that people can trust, that people can rely on? And we have to be a brand that people trust. So when we're giving guidance, I'm also thinking about that. I never want to miss what we tell someone we're going to do. Because if we do miss what we tell someone we're going to do, then we're eroding that brand, we're eroding that trust, we're eroding that culture that we're establishing. And so that's not to say that our guidance is sandbagged. It's just meant to say it's a responsible guide.
So I feel like a lot of people have this idea that Anthony Noto and management actually have a secret hire guide, but they're purposely sandbagging their hire guide in order to beat it. I honestly believe that Anthony Noto and management, if they're not purposely sandbagging, they have this range of what they expect their earnings to be, and they always guide for the lower end of the range. And basically, this lower end of the range, how they get to this range, they first have this base case of the economy, and then they add on top SOFI and management's execution. The only problem is, you know that first we expected at least 2 interest rate cuts in 2026. And then that was revised down to only 1. And now we might even see an interest rate hike. Basically, SOFI, they expected this range, right? And then they expected the economy to be this range, right? And then the economy kind of just shifts down because it went from an interest rate cut to either holding still, higher for longer, or even an interest rate hike. So it shifts down. So that means that SOFI's execution, right? They're still executing equally well. It's just shifted down because basically the rug was pulled under them. They're not purposely sandbagging. They're just giving you a very conservative estimation of what they think their earnings is going to be. Okay, so those are the main kind of summary points of the earnings. Let's dive deeper into specifically personal loans first. In Q1 of 2026, SOFI made $12.2 billion of loan originations and kept $9.2 billion for their lending segment, so they're holding the loans on their books, and then $3 billion was for the loan platform business. Of those $12.2 billion of loan originations, they had their best quarter of student loan originations at $2.6 billion. And they said, this is the best. I want you to remember that SOFI started off as a student loan company, like only student loans. And then they got rug pulled by the US government when they paused the need to pay for student loans. And the fact that now it's their best, so currently their student loan origination is better than when they only had student loan originations. I want that fact to just sink in. We can also talk about records for their home loans, where they originated $1.2 billion in home loans in Q1. But this is when everyone starts to question something. Why is it that SOFI decided to keep $9.2 billion for their own lending segment and they didn't put $9.2 billion into the loan platform business? Is it because there's fewer people willing to buy their loans? And Anthony Noto actually answered this multiple times. We're not really seeing any issue with our own performance, nor in the demand that we have for the LPB revenue and loans from our partners. In fact, we have demand above our contractual obligations that we have on volume that we're producing. So that should technically shut up every single bear. But he continues because people keep asking. Our strategy for what we put in the balance sheet versus through the loan platform business remains guided by the principle that LPB loan originations reflect incremental volume that we would not otherwise originate for SOFI's balance sheet for a variety of reasons, including capital ratios, managing the overall growth of the balance sheet, and the credit profile of borrowers. In other words, they're keeping this $9.2 billion in their books because it matches what they're looking for. The profile of those loans match what SOFI feels safe enough to keep on their books. Another thing we have to note is that SOFI also is expanding their credit box. So last quarter, there was an average FICO score of 746. That was last quarter. This quarter, it's 745. It's only 1 credit point difference, but it's still a difference, and it shows you that SOFI is expanding their credit box, right? And they're doing so safely. By expanding their credit box, they're expanding their TAM. But also, you see, estimated all-in net charge-off rate was flat quarter over quarter. So they expanded their TAM while basically keeping their risk in check. And then even if you do include the impact from delinquent sales, net charge-off rate was 3.3, which is up 23 basis points from the fourth quarter 2025. And is that really scary, this 23 basis points up? Well, not really, right? Because SOFI later on down here says this, the data continues to support our 7 to 8% net cumulative net loss assumptions for personal loans. So SOFI has risk in mind always. SOFI is very conservative. SOFI tries its best to be as financially responsible as possible. Another thing I want to note to everyone is that when they do increase or widen their credit box, what does that mean? That means that they're loaning to people that have lower credit scores. And what's something about lower credit scores? You have higher margins. Our net interest margin was 5.94 for the quarter, up 22 basis points sequentially. Where do you think this is coming from? Because you're loaning to people that might need a higher margin rate because they're slightly less safe. And even later on, they say we continue to expect a healthy net interest margin above 5% for the foreseeable future. So yes, there is a lot of demand, right? Did sell all demand from our contractual commitments and more. If you really think about it, why would SOFI not do this? If you do believe that your loans are safe and you do make more money over the lifetime of the loan, why would you not? You have to remember that SOFI did have that $1.5 billion cash raise in December 2025. SOFI could either put that $1.5 billion in cash and just get 3 to 4% interest, or they could get the 5.9 for almost 6% of interest margin. What would you prefer? Obviously, you would prefer this. So those are my thoughts on SOFI's loan business and why I think this is the case. I will say there is one possible bearish note you could take, which is basically that of this $9.2 billion, so you have to remember that SOFI's key demographic, their key customer or their core customer is the Henrys of the world. And when you have more Henrys taking out more loans, that might be like a canary that tells you, or the previously like white collar workers, those like software engineers or doctors or whatever, are they taking out more loans? So that's something to keep in mind, keep in the back of your mind. And something to take note of in future earnings. Next, let's talk about marketing, just because there's been so much news. I think marketing efforts and advertising efforts were mentioned so many times in this earnings call. In March, ranked number 1 by JD Power 2026, number 1 US bank by Forbes. TGL, you have NBA playoffs, expanded their talent partnership, kicked off Future Wealth Summit in national campuses, targeting, I guess, basically just future professionals, college students. They're expanding their student loan, which is also a form of not really marketing, but like you're kind of creating a ramp for future Henrys of the world to join the SOFI ecosystem. Not really marketing, but another driver that is pushing more people to get more products is this SOFI Plus. Because of how much value the SOFI Plus membership provides, you will see that people will be inclined to join SOFI Plus, and when they do join SOFI Plus, they'll probably be inclined to get more products, right? So SOFI Plus and how much value it offers really will, in my opinion, push more users, push more members to buy or use more SOFI products. Not to mention that SOFI Plus is also another revenue stream for SOFI. Also, SOFI Plus also does encourage more users to have at least $20,000 in their banking account. So that's just another plus. And all those marketing efforts, all those advertising efforts does lead them to have unaided brand awareness rose to an all-time high of 10%, right? And it just keeps growing, right? And you still have to realize that SOFI is a pretty small bank, but they're growing, right? They're getting more brand awareness, and that's only going to increase over time as more people go to SOFI Stadium. More people are watching basketball, watching golf, watching football, and that's just going to lead to more members, more products, more revenue, right? And more shareholder value. Now, the part that everyone talks about, the single bear case that is on everyone's mind, is the tech platform business, which is the part that every bear talks about, right? We do have this net revenue of 75 million. So this is actually quite bearish because I think they projected around like $320 million of net revenue. And that's showing you like single digit growth quarters over 4 quarters. So that's not that great. And I will be the first to show you that, or to say that. But there are some nice things, right? They're doing a rebrand, they're doing a relaunch, which hopefully this will be something like what happened with SOFI Plus, where SOFI Plus, when it was first launched, it wasn't that great, but then when they do relaunch it, maybe it'll be better. Additionally, they have 13 new clients, which generated revenue. But this says they have 13 new clients that generated revenue, but it doesn't include any clients that did not generate revenue. So it's possible that they actually have a lot more clients that are not currently generating revenue, or a lot more people that are trying to onboard but have not made a single dime or a single penny for SoFi Bank. But I do want to point one thing, and I've said this in multiple videos before, but even though the tech platform business isn't doing as much revenue as anyone would want it to do, the tech platform business allows SoFi's flywheel to actually work. The other parts of SoFi's business would probably fail without this tech platform business. So yeah, you could say that the revenues aren't that great, but the tech platform business is kind of the moat that SoFi has. And in my opinion, I feel like the tech platform business probably isn't doing as well, because I think that SoFi is kind of keeping all the more strong moats of the tech platform business to itself, so that basically SoFi doesn't lose this moat to competitors or to the tech platform business customers. Because you even see right here, right? For SoFi Bank, our core process platform will integrate seamlessly with our payments, fraud, and card capabilities, and importantly will support ledging for stablecoins on day one. In fact, the modern core will serve as the backbone for our planned crypto endeavors. Noto even says it himself: if we didn't have the technology platform business, there's no way we would have been able to launch crypto buy, sell, and hold in such a short time period, or SoFi USD. So that tells you exactly how much of a moat the tech platform business is. From crypto, we can talk about big business banking, because I think that big business banking, a lot of it, their first few customers will probably be crypto related, because a lot of it has to do with crypto capabilities. For example, right here it says our big business banking clients can hold funds in regulated business deposit accounts with institutional grade safeguards, move money in crypto in real time, API driven payments, and convert fiat and crypto instantly through native SoFi USD mint and burn capabilities while maintaining reserves with SoFi's regulated environment. So this is huge, right? Especially after the Clarity Act passed, which is something that helps SoFi a lot more than other companies like Robinhood or whatever. Why do you think the Coinbase CEO was against the edits or against the current makeup of the Clarity Act? It's because it helps banks a lot more than it helps other fintechs. And SoFi having the first public and permissionless stablecoin, it's definitely gonna help SoFi a lot more than its competitors. The first national bank to launch its own stablecoin on a public permissionless blockchain. And SoFi and management actually really do believe in crypto. They say that we believe the crypto super cycle that is underway will completely transform financial services, enabling frictionless money movement. But also, when asked about M&A, Anthony Noto says that for M&A in general, they want to prioritize things specifically tied to SoFi technology systems, the tech platform business, but also things revolving credit as well as crypto and blockchain services. So anyone worried that the tech platform business is just something that management is just throwing away, this is completely countered by what Noto said at the very end of the earnings call, right? It seems that the tech platform business and crypto are front and center in management's mind, right? And they're looking for ways to improve it. They're looking for things to add to it, to make it as valuable as possible to the customers of the tech platform business and to SoFi in general. But from M&A, we also have to remember that this week alone, it was disclosed that SoFi acquired 2 new companies, right? Composer, which is like an AI algo trading, which I think that this fits perfectly with SoFi's core demographic of Henrys, right? The people that are too busy to work to look at stocks. Well, if you're too busy to work because you're working during market hours to look at stocks, then it only makes sense that you would want to have some type of algo trading or some type of automatic algorithmic trading strategy that you would employ or that you would use in order to do your trading for you. Additionally, Composer being from Canada also gives them a foothold in Canada. Is Canada that big of a market? No, but it still does show a foothold in an international market. Secondly, we have SoFi buying Primary Bid. And the coolest thing about Primary Bid is that Primary Bid was a previous SoFi partner. This means that it will be really easy to integrate Primary Bid into SoFi's ecosystem really quickly, because they already have the underlying infrastructure to work with Primary Bid. When it was a partner, they just have to turn on some UI elements, and bada bing bada boom, SoFi is now integrated with Primary Bid. And this is especially important in this environment when you have all these really big IPOs coming up in the short to medium term, that this can be a really big revenue driver. Think about Claude, OpenAI, SpaceX. I don't know if they'll make it in time for SpaceX, but at least OpenAI and Claude, You don't think that retail investors would want access to IPOs like that? So primary bid, I feel, is going to be a really big revenue driver for SoFi and also going to attract a lot of people to SoFi's Invest product. Now, after all this, I want to talk about what I believe to be SoFi's worst performing segment, which is credit cards. In all of Q1, SoFi has added an additional 400 credit cards. Not million, not thousand, 400. In an entire quarter, SoFi added 400 new credit cards. Why is this so bad? What the hell happened? The credit card sector of their business performing so poorly is actually one of the main reasons why I'm so bullish on the company. They have a mission statement, and their mission statement is, we help people reach financial independence to achieve their ambitions, helping them get to the point where they have enough money to live where they want, have the size family they want, the house that they want, the career that they want, and retire when they want. And credit cards are the antithesis of that, because how do you can't fund the bonuses or the cash back of credit cards without screwing some people over. This is exactly why the LPV doesn't work, why other banks don't do this type of loan refinancing. It's because it's cannibalistic to their credit card business. And this is exactly why SoFi's credit card business is bad. It's because their loan business, their refinancing business is so good. Because why would you sit with their 20%, 30% APR interest rate on your credit card when you can instantly turn around and get a personal loan for, let's say, 6%, 7%, 8%? You wouldn't, which is exactly why SoFi's credit card doesn't have the perks that other credit cards have. And in turn, that basically means that there's no real big incentive for people to use SoFi's credit cards, because you're not going to get the suckers that are paying that 35% interest rate to pay off the 5% cash back that someone else has. I think we can end off with this part. We cannot just offer products that are the most attractive financially. We need to be there for our members, not just for the large financial decisions in their lives, but for all the days in between. And I think that this statement is exactly why I'm so bullish on SoFi, because they care about their members. I think Bezos said some time ago, I forget the direct quote, but something like, what benefits the customer in the long term always benefits the shareholder. And that's exactly the mindset that management at SoFi and Anthony Noto has. Our goal is to have the greatest impact on our members of any company in the world. And in doing so, we will be the winner that takes the most in driving value to our shareholders. Basically just a rewording of the Amazon quote that I just said. So was the SoFi earnings at 100%? It wasn't, right? There were some weaknesses, but there was definitely a lot of growth. And I honestly don't believe that it deserves the price that it is right now. It's at $15.50. This is definitely a sentiment problem, because the entire market is showing it, right? No one really wants to invest in banks, in fintech, in software, because all the money is in AMD, in NVIDIA, in the AI play, in the infrastructure play, right? In the data center play. So why would you invest in a stock that might be growing like 20% a year, when you can invest in an AI related play that's increasing 200% a year, 300% a year, right? So this is still a sentiment play. I think that right now SoFi is completely undervalued, but it's going to take some time for the market to warm back up to those undervalued bank plays, those undervalued fintech plays, those undervalued software plays. So do I think that you should invest right now in SoFi? I think that if you're not exposed to SoFi at all and you're willing to hold for long term, right now is a great buying opportunity, but it's just going to take some time for the market to warm back up to those plays. So that's this video on SoFi Technologies, ticker symbol SOFI. I'm still super bullish. It's growing, it's firing, and in a lot of cylinders. Again, you have to stay a lot of cylinders. Tech platform business, it's going to take some time for it to mature and for them to rework it to where it's more attractive to potential customers. But other than that, super bullish on SoFi Technologies, ticker symbol SOFI. Peace, have a good day, bye.